Hey guys, Stockaholics, thanks for being here today. Um, it's been a few weeks since I've made a video. Thought I'd come back, make a update on tankers. It's been a lot of chatter lately talking about the upcoming winter season and how the potential energy crisis that you see permeating a lot of the media lately, how that could potentially affect tankers. So I'll share some of that and some of my thoughts around those things. I also wanted to take a look again at scrapping and cost pressures because we are still in a bear cycle as of today for oil tankers. And I also wanted to think a little bit about cycles and some kind of fractal patterns, some patterns over time that we notice in shipping, and think about where we could be in the tanker cycle based on history. As of today, oil tanker rates are still very much lousy, as they have been for at least the last 12 months. It is mid-October right now, and we are heading very soon into the seasonally strong earnings season. Over the next couple of weeks, typically you would expect to see oil tanker rates increase. I have seen some reports from various analysts where they say that they are seeing increased activity taking place in tanker hotspots, I guess. So we'll really get to see. By November, by Thanksgiving is when you typically see the big pop in seasonal earnings for tankers. So we'll really get to see what the supply and demand balance looks like for the fleet when that comes. What we're looking at here is the U.S. crude oil inventory. And for a long period of time, we were well above 5-year ranges. I remember making videos like a year ago talking about that. But today we are towards the bottom of those 5-year ranges in terms of land oil storage. So what this suggests is, and this isn't true for the only true for the United States, it's true for different places in the world. What it suggests is that we are very likely to be entering a period where there's going to be an increased demand for seaborne transport of crude. One of the big mysteries is China. So you don't really have access to opaque data and on this kind of statistic in much the way you do in other countries. So, and China is one of the bigger players in terms of crude oil imports. So I don't know, it's another one of those things we'll just have to wait and see, I guess. I wanted to share this with you guys. This is a slide from Hunter Group. Basically what they're showing is what tends to happen when oil inventories, oil land inventories get very high and very low. And this goes back a few decades. Over here you can see in 2002 approximately, there was very low land oil inventories. And what you saw afterwards is a restocking period. And as a result, you tend to see these higher rates in VLCCs and other types of vessels in the oil tanker space. But when they get to peaks, the opposite tends to happen. There's less demand for these tankers, they're underemployed, and rates tend to fall. But you can see here there's cycles in this, just like there are cycles in the tankers themselves, right? Every time that it tends to get low, rates tend to follow, tend to increase, or tend to rapidly increase afterwards, right? Seen that many times. And recently we've known since the contango situation where the market was just absolutely flooded with oil, rates have since then been plummeted, right, or to all-time lows since not seen in a very long time. So land inventories right now are very, very, very low. So it asks the question, what's going to happen in the next couple of months during the restocking? You would expect that if it's just like every other time in the past, you would see an increase in rates. Right, lately in the media, you've been hearing a lot about shortages. Among those kinds of shortages are for energy. What's very interesting is the price of both coal and natural gas have just absolutely exploded over the last couple of months. And that's having some interesting effects on terms of demand for substitutes. So I wanted to share this article with you guys. Oil prices have vaulted to multi-year highs after OPEC and other major producers opted last week against increasing output by more than previously agreed. I want to clarify some of that language there. They are agreeing to increase production gradually. That hasn't changed. but there was some speculation that there would be an increase in the production further than the output that they had agreed to prior. However, it's the natural gas trajectory that has been hogging the limelight after gas prices surged more than 300% to trade at its highest levels since 2014, outpacing oil and many other commodities. With the global energy market remaining on fire, natural gas prices are increasingly impacting crude oil as well, with consumers looking for cheaper fuels to substitute. Indeed, a major anomaly has now emerged. Power producers are doing an about-face by switching from costly natural gas to oil, a reversal from the decade-long trend of transitioning from costly oil to cheaper and cleaner natural gas. Now, there are only so many electricity producers that can do this. They have to have the ability to be able to burn oil to produce electricity. Not all of them do. And there's a lot of them that are generally that are in the East. And by the way, that is where if you would expect to see a lot of tanker demand, transporting fuel to those places. JP Morgan has put the potential boost in oil-fired power generation by power generators switching to oil as high as 2 million barrels per day, but says that 750,000 barrels per day by March is more realistic. Meanwhile, the normally conservative International Energy Agency has placed the demand bump at a modest 200,000 barrels per day and says the switch will be more rampant in Indonesia, Pakistan, the Middle Eastern states, and Bangladesh. I kind of also wonder what this is going to do to things like heating oil. Maybe that in various places in the world where you might be able to use natural gas to heat, but you have access to heating oil, which is, a third of the price. Maybe that would increase oil demand as well. I don't know, but we'll find out very soon. A few days ago, I was going to make this video, and I was going to use the strong language of a possibility of a pop in rates this winter. But I've kind of heard a few different people talking about this, and I want to change that language from not so much a possibility, but a little bit higher than that to kind of a probability, okay? But I certainly wouldn't say that it is a certainty that we see a significant pop in rates this winter. And I wanted to share with you why. And I shared this a few months back. This is from Potent Partners and one of their potent opinions. And this is basically looking at VLCC supply and ton-mile demand. And we're coming from a very low base in terms of ton-mile demand. So there's a big gap to make up this winter. So we are going into the strong winter season. We do know that oil inventories are low. We do know that there's probably an increased demand for oil coming up very soon, and maybe an increase in OPEC production. But I want to keep in mind that there's a big, a big gap to be made up here for freight rates to go in tanker owners' favors. Now, we are still very much in a bear market, so I wanted to put that bear market lens on and look at all of the things that we really want to see in order for there to be a sustained bull market rally in tankers. And we're going to take a look at the conditions that lead to scrapping. So first of all, we're looking at scrap steel prices. They are still at very, very, very elevated rates. So if anybody is thinking about getting rid of that excess old tonnage, they're still very much incentivized to do so. I would expect, though, that the rates that we have recently see go down a little bit through the winter months. And that is because that's the strongest earnings season, right? So there's probably a lot of owners out there who are hanging on to their tonnage to wait and see what happens this winter. If we do not have a winter pop this in the next couple of months, I would expect that you will see very significant scrapping. And I'll show you guys why in a little bit when we look at cycles. In addition to the incentives that I've mentioned many times for the high scrap steel price, there is increasing pressure in terms of fuel prices for ship owners right now, right? We have mentioned this before. There's a spread between the different fuel types if you have an eco vessel versus a non-scrubber eco vessel equipped tanker. And what we're looking at here is VLSFO. This is essentially if you don't have a scrubber on your oil tanker, the price you're paying for fuel, extremely high right now. And HSFO, if you do have a scrubber, a little bit cheaper. Now, if you have an old ship that is inefficient, you're paying extremely high fuel prices, and you have there's a high scrap steel price, you are still very much incentivized to go out and scrap ships. And recently we have seen additional scrapping. Since the last video I made, we've seen, based on this report from Compass Maritime, we've seen one VLCC slash ULCC. By the way, I noticed recently that I have been always calling this number here VLCCs. That category also includes, by the way, ULCCs. So I need to clarify that. I don't go out every week and look at whether it's a VLCC scrapped or a ULCC. In my opinion, if it is a ULCC being scrapped, that is awesome because ULCCs have even more crude oil deadweight tonnage that can be held inside their vessel compared to a VLCC, okay? And that's how I think of the overall tanker market, is in terms of ton mile demand for the entire fleet, including both crude and product. And there's also a Suezmax, 2 Aframaxes, and 1 Panamax that was scrapped last week, or since my last update. I wanted to share this with you guys to kind of give you a visualization on how scrapping cycles almost always take place in the shipping industry. So down here, by the way, this is total fleet demolition activity over the past 24 months. These gray bars down here represent bulkers that were removed from the fleet. By the way, there's a lot of scrapping over the last year and a half, or in 2020 and 2019. But you can see that now that the bulkers are starting to earn a lot of earnings right now, the scrapping very muted, at least compared to where it was in the recent past, right? And as they earn more, or they still have very high rates, I would expect this to remain very low, at least for the coming months. In 2020, you had oil tankers somewhere around here where they were earning a tremendous amount of money. And in 2019, to some extent with the Costco sanctions, where they just had a lot of earnings. And as a result, they ordered ships, and as a result, they didn't scrap many ships, right? But you can see over time, as we get 12, 18 months into a bear cycle, you really start to see the amount of scrapping in that industry accelerate. Now you look at container ships, the opposite is true, right? Now, over the last 18 or so months, they've had just blowout earnings, unseen earnings like ever. And as a result, they have almost no scrapping. And I would expect that over the next 12 or 18 months, when those rates inevitably revert, you will see very muted scrapping activity. What is very interesting to me is I've listened to a bunch of these panels lately, and you hear all these, the same kind of tropes you hear, where all of the different shipping owners, well, it's going to be a bull market in our XYZ shipping segment because we just don't know what ships to order. And I want to suggest that is complete BS. They know exactly what ships to order, because if you look at the order book, the amount of container ships is like approaching like 25% of the fleet right now. So don't listen to what these guys say. Go look at the data and go look what they do. But where we are now in terms of tankers, we are deep into that bear cycle. And again, if we go into the next couple of months where there isn't a pop in rates during this winter, you can expect this to accelerate even more. And to really show that to you guys, I wanted to show you guys this. So in 2015 and 2016, by the way, this is tanker demo sales and scrapping over the last decade or so. In 2015 and 2016, oil tankers made a tremendous amount of money. Actually, more over here. But once you started getting over here, they had very lousy earnings. And about 12 months later, you really started to see scrapping pick up in 2017. Same thing in 2018, rates were still horrible, and you saw an even further acceleration in earnings. Where we are now really reminds me of 2017. And we just went through basically in 2019 and 2020, a period where tankers earned a tremendous amount of money. Now we're 12 to 18 months out, and we are seeing accelerated scrapping. So in my view, I think the most probable area where we are in the shipping cycle is the equivalent of 2017. And these move in 4-year cycles, by the way. So it's very interesting, these fractal patterns you notice. My expectation is that in the next couple of months, we should be, if we don't see a pop in rates this winter, we are going to see the kind of scrapping that you saw in 2018 when you really see that older tonnage just get removed from the fleet. My hypothesis is that I think there's a lot of tanker owners out there who are still waiting to see what's going to happen this winter. And I guess we are too. What we're looking at here is historical VLCC new building prices adjusted for inflation. So there were a period when those prices skyrocketed and a period when those plummeted. And what is very interesting to me is that this has a sort of fractal pattern that repeats through time, not exactly on the exact same time scales, but there's definitely a pattern here, right? By the way, one of the things you notice is there are periods when these prices or these asset values increase tremendously, right? So when I hear a lot of people suggest that some shipping segment stocks are undervalued because they're below NAV, but they're in a raging bull market, I would suggest that if you're somewhere over here, that NAV could decrease quite rapidly if you get that timing wrong. Okay, so really you want to be purchasing, in my opinion, these vessels when the NAVs are below the cyclically adjusted averages. Okay, and that's not something you ever hear anybody talking about in shipping, but I digress. What I thought was really interesting here is that there's fractal patterns. Okay, and these are the things that repeat throughout history. And right now, you hear, well, we've been in a bear market for 10 years, you know, but I think that that has some real merit, right? Because every time in the past we've been in a bear market for 10 or so years in almost every shipping segment, you see that there is a bull market that takes place, right? And recently we've seen that with every shipping segment except for tankers. So, yeah, I can't explain what would cause the next bull cycle for tankers, but I would suggest that it is a distinct possibility, although we don't ever know what will cause the next cycle to go and do what it does. There's more I could talk about, but I think that's enough for today. But hey, again, I'm excited to see what's going to happen in the next couple of weeks. Let me know what do you guys think is going to happen? Are we approaching the long-awaited bull cycle for tankers, or are we another year out? Let me know in the comments below. I'll see you guys soon.